For most people, high interest rates feel like bad news, and understandably so. Mortgage payments become significantly more expensive, car loans cost more, credit card debt grows faster, and businesses often slow their hiring in response to higher financing costs. News headlines frequently describe rising interest rates as a burden on families and the economy, and the immediate financial pressure felt by borrowers seems to confirm this assessment. Yet behind closed doors, many wealthy investors and financial institutions often experience something remarkably different when interest rates climb. To understand why this contradiction exists, you have to look beyond the simple mathematics of borrowing costs and examine the fundamental mechanics of how wealth is actually built and protected in modern financial systems. Imagine two neighbors living on the same street in a quiet, suburban neighborhood. Alex works a full-time job at a mid-sized company, carries a 30-year mortgage on a home worth $750,000, maintains a car loan for a recently purchased vehicle, and has accumulated several $1,000s in credit card debt from everyday purchases and unexpected emergencies. Alex represents millions of ordinary families who depend on borrowed money to access housing, transportation, and the ability to bridge gaps between income and expenses. Across the street lives Robert, a successful entrepreneur and investor who owns several businesses generating substantial annual cash flow, maintains a portfolio of rental properties with paid-off mortgages, holds significant equity positions in dividend-paying stocks, and has accumulated millions of dollars in savings and investment-grade bonds positioned across his portfolio. Robert represents the financial elite, whose wealth comes not from monthly paychecks, but from the income generated by assets and the strategic deployment of capital. When the central bank raises interest rates, Alex immediately feels the pressure. If Alex has a variable rate mortgage or has refinanced recently, the monthly mortgage payment increases, leaving less money for savings and meaningful investments. New car loans carry higher interest charges, making the monthly payment significantly more expensive than it would have been 6 months earlier. Credit card interest rates spike, and with a balance that takes months to pay down, the daily interest accrual accelerates, meaning more of each payment goes toward interest and less toward actually reducing the principal balance. Higher rates mean that financial breathing room disappears, forcing difficult choices between saving for emergencies, investing for retirement, and maintaining basic lifestyle stability. Robert, however, experiences something completely different when interest rates rise, something that seems to defy intuition, but reflects how wealth concentrates in capitalist systems. As interest rates rise, banks begin paying substantially higher returns on savings accounts, certificates of deposit, and government bonds. Robert, who has millions of dollars invested in income-producing assets, suddenly earns much more from simply lending his money to financial institutions and the government. $1 million earning 0.5% annually in a low-rate environment generates only $5,000 per year, but that same $1 million earning 4% in a high-rate environment generates $40,000 per year. Instead of earning almost nothing on cash reserves, Robert collects substantial interest income without taking any significant investment risks. The difference in annual income is $35,000 from just $1 million of capital. For someone with $50 million in liquid investments and bonds, the annual income from rising rates could easily exceed $1.5 million. The wealthy often have large amounts of capital already deployed, so even small increases in interest rates generate thousands or millions of dollars in additional annual income, effectively rewarding them for simply holding money in safe financial instruments. Higher interest rates also tend to cool overheated markets and increase financial stress throughout the broader economy. As borrowing becomes more expensive, some businesses delay expansion projects, consumers reduce discretionary spending, and investors become more cautious. Asset prices, including stocks and real estate, may stop rising or even decline as investors reassess valuations in light of higher discount rates. While this dynamic worries many ordinary people who depend on asset appreciation to build wealth, or who fear job losses from economic slowdowns, experienced investors and the wealthy see these market corrections as something entirely different. When asset prices decline due to economic stress and higher borrowing costs, Robert sees opportunity. Because he has accumulated substantial cash reserves during the years of strong returns, he possesses what financial professionals call liquidity. With this liquidity, he can purchase quality assets at significantly lower prices, while others are forced to sell due to financial distress. Wealthy investors often follow a simple but powerful principle: buy when others are fearful and sell when others are overly optimistic. Market downturns create the fear that generates prices low enough to generate exceptional long-term returns for those with capital and patience. Meanwhile, families like Alex face increasing financial pressure. Some homeowners with adjustable rate mortgages or recent refinances see their monthly obligations surge by hundreds or thousands of dollars. Small business owners who depend on debt financing for operations and expansion face rising costs that compress profit margins. Consumers relying on credit cards find that their outstanding balances require substantially more interest payments each month. Those without emergency savings may be forced to sell investments or property at unfavorable prices simply to cover unexpected expenses. The psychological impact of rising rates compounds the financial impact. When markets decline and economic uncertainty increases, workers worry about job security, making them less likely to spend or take financial risks. Robert understands that financial stress creates buying opportunities because desperation drives prices down to levels that make exceptional returns possible over time. High interest rates also work to reduce inflation over extended periods. When inflation slows, the purchasing power of cash becomes more stable and predictable. For wealthy individuals who already own diversified portfolios and maintain significant cash reserves, this creates a more predictable environment for long-term investing. Stable prices make it easier to evaluate business opportunities because the purchasing power of future cash flows becomes more certain. When inflation is high and erratic, it becomes difficult to know whether rising prices represent genuine business growth or just currency devaluation. For Robert, modest inflation is actually preferable to very high inflation or deflation. And stable, modest inflation in a higher rate environment represents an ideal context for deploying capital across multiple asset classes. However, the picture becomes more complex when examining different types of wealthy individuals. High interest rates are not universally beneficial for all members of the wealthy class. Wealthy entrepreneurs who have built businesses that depend heavily on borrowed money may also face significant challenges when borrowing becomes expensive. Real estate developers who leverage debt to finance projects, technology startups that have grown through cheap debt financing, and companies operating on thin margins with high leverage often find expansion much more difficult when interest rates increase. For these leveraged wealthy actors, rising rates can pose genuine problems. The key difference is that many wealthy individuals have enough financial flexibility and diversification to adapt to changing economic conditions. If leveraged real estate development becomes unprofitable due to higher borrowing costs, Robert might shift capital from real estate into bonds paying attractive yields or dividend stocks, generating 5% or higher annual income. The non-wealthy typically lack this flexibility because they depend on specific income sources and borrowed money to maintain their lifestyle. Alex eventually realizes that the difference between his financial position and Robert's position is not simply income, but financial structure. Alex depends on borrowed money to access essential things like housing and transportation, meaning rising interest rates directly increase monthly obligations and reduce financial flexibility. Alex's wealth building depends on borrowing money at lower rates, using that money to buy assets, and hoping those assets appreciate fast enough to generate a return that exceeds the interest cost. Robert owns assets that produce income regardless of economic conditions and interest rate levels. Rising interest rates reward savers, disciplined investors, and those with available capital. They simultaneously place greater pressure on borrowers, forcing many to reduce spending and delay wealth building. The lesson is not that high interest rates always make the rich richer in simple ways, but rather that people who own productive assets, maintain substantial liquidity, and avoid excessive debt are positioned to benefit when economic conditions change, while those dependent on borrowed money face pressure that compounds over time. This dynamic plays out across the entire economy in ways that many people never fully recognize. When interest rates rise, the S&P 500 yields only about 1.1% on average, but individual dividend aristocrats and high-yielding stocks within the index generate 5% or higher annual returns from dividends alone. A millionaire holding dividend stocks that generate 5% yields earns $50,000 annually without working, without taking risks on business ventures, and without relying on market appreciation. That $50,000 is now enough to fund a comfortable middle-class lifestyle for many American families. For someone with $10 million in dividend-generating assets, the annual income reaches $500,000, dwarfing what most people earn through active employment. Meanwhile, Alex works full-time to generate gross income that after taxes, deductions, and mandatory debt payments, leaves relatively little for accumulation. Real estate provides another powerful example of how interest rates affect different wealth classes. When interest rates were near 0% and borrowing was nearly free, real estate developers and institutional investors could borrow money at essentially no cost and bid up property prices to extraordinary levels. Higher borrowing costs now make these calculations less attractive for marginal developers and small investors who were using leverage aggressively. However, established real estate investors with paid-off properties or substantial down payments see something different. If Robert owns an apartment building worth $5 million with annual rental income of $400,000, the property generates an 8% cap rate or unlevered yield. If Robert paid cash for that property, he is receiving an 8% annual return simply from the rental income produced by the property, regardless of interest rate levels. As interest rates rise, cap rates often rise as well, meaning new properties might be valued at lower prices to generate the same yield that investors require. Robert can sell the appreciated property from earlier years and redeploy the capital into multiple new properties, because rising rates have reduced prices to levels that generate attractive yields. Lower prices benefit Robert, who has cash, while higher borrowing costs burden Alex, who needs to borrow to access real estate. The concentration of wealth among the super wealthy has accelerated dramatically, and interest rates play an important role in this dynamic. In 2024 alone, global billionaire wealth surged by $2 trillion, equivalent to $5.7 billion per day, bringing the total holdings of the world's billionaires to $15 trillion. The pace of wealth accumulation has accelerated 3 times faster than the year before, with 204 new billionaires created in just 12 months, nearly 4 every single week. These extraordinary gains come from multiple sources, including capital appreciation in stock holdings and real estate, but also from the income generated on large cash positions in a higher interest rate environment. In the United States alone, billionaire wealth increased by $1.4 trillion in 2024, creating 74 new billionaires and bringing the total count of American billionaires to 902 with combined wealth of $7.6 trillion. This concentration of wealth has created a situation where the richest individuals are making more money from interest income alone than most people earn through their entire careers of full-time employment. Meanwhile, ordinary households struggle with rising debt burdens and stagnant income growth. Student loan delinquencies have surged dramatically, reaching 7.74% for 90-plus days delinquent in early 2025, the highest level since the pandemic, as past due reporting resumed after nearly 5 years of pauses. Credit card delinquencies have increased, reaching levels above the pre-pandemic average, with some reports showing that early delinquencies on credit cards reached 9% by late 2025. Auto loan delinquencies have climbed to historically high levels, as higher vehicle prices combined with elevated interest rates have driven monthly payments up nearly 30% since 2020. Vehicle repossessions are at their highest levels since 2009, indicating that millions of households are unable to maintain payments on vehicles essential for accessing employment. The wealth inequality gap has reached unprecedented proportions, with the richest 10% of the global population taking home 52% of total income, while the poorest half takes home just 9%, and the wealth disparity is even starker, with the richest 10% owning 76% of all wealth, while the poorest half owns almost nothing. This inequality dynamic is not accidental but structural, built into how financial systems reward asset ownership and punish debt dependency. A researcher named Atif Mian at Princeton published widely cited research showing that as the rich get richer in terms of income, they save substantially more of that income than lower income households. This creates what economists call a saving glut. The wealthy save massive amounts of capital, which lowers interest rates by increasing the supply of loanable funds. Low interest rates then make assets cheaper on a present value basis and drive asset prices higher. This asset price inflation benefits the wealthy, who already own assets, while leaving lower income households further behind. When interest rates finally rise in response to inflation concerns or monetary policy changes, this benefits the wealthy directly through higher returns on savings, while simultaneously placing stress on borrowers. It is a vicious cycle where inequality begets more inequality, and the wealthy are structurally positioned to benefit from both rising and falling interest rates, depending on their asset composition and financial position. Consider how this plays out practically in the housing market, which represents the primary path to wealth building for most middle-class families. When interest rates rise from 2% to 5%, the monthly payment on a $500,000 mortgage increases from $2,146 to $2,684 per month, a $538 increase, or about 25% more each month. For many families, this difference makes home ownership impossible at current prices. However, for someone who already owns multiple properties with paid-off mortgages, rising interest rates have 2 positive effects. First, they can earn 4% or more on cash reserves without taking any risk. Second, higher mortgage rates reduce demand for real estate, potentially creating buying opportunities as sellers become more motivated to close sales. An investor with $10 million in capital can now purchase 20 properties, where before they could have purchased only 16 or 17 because the buyer pool has shrunk and sellers are more willing to negotiate. The bond market provides yet another mechanism through which interest rate increases benefit the wealthy. Government bonds, corporate bonds, and various fixed income securities now offer yields in the 4 to 5% range, returns that are meaningful and relatively safe. A retiree with a $10 million portfolio moving from 3% average returns to 5% average returns generates $100,000 more per year without any additional effort or risk. For the average retiree or middle-class worker, this difference is immaterial because they do not have significant capital deployed in bonds. For someone with a $100 million portfolio, The difference between 3% and 5% returns represents $2 million per year, enough to completely change life circumstances. This gap between the returns available to capital and the wages available to labor is a primary driver of growing wealth inequality. The psychology of market cycles and investor behavior also creates advantages for those with capital in high interest rate environments. During periods of economic uncertainty driven by rising rates, asset prices typically decline. Ordinary investors with limited capital hear news of market declines and often panic, locking in losses by selling at prices far below what they paid. This emotional, panic-driven response to market volatility is entirely rational for someone with limited capital, because they may need that money for emergencies and cannot afford to wait years for recovery. Wealthy investors with both capital and alternative income sources can remain calm during market declines, understanding that historically every market crash has eventually recovered. The 2008 financial crisis saw the S&P 500 decline nearly 57%, but investors who held through the decline and continued purchasing at lower prices saw the market eventually recover and reach record heights. Those with capital and time can profit immensely from this volatility through disciplined buying and patient holding. The practical outcome is that interest rates represent a fundamental redistribution mechanism in capitalist economies, one that operates continuously and often invisibly. Higher interest rates increase the burden on those dependent on borrowed money, while simultaneously increasing returns for those with capital to lend. This is not a moral failure or personal failing of either group, but rather a structural feature of how financial systems operate. Those who control capital benefit from the income generated by that capital. Those who borrow to finance consumption or asset purchases face higher costs, and the gap between these two groups expands over time. The phenomenon is self-reinforcing because wealth from the wealthy allows them to accumulate more capital, which generates more income, which allows even greater capital accumulation. For ordinary households like Alex, the path to financial security requires painful diligence and discipline in a system structurally designed to extract value from borrowers and redirect it to capital holders. Building emergency savings of 3 to 6 months of expenses becomes essential precisely because unexpected events can force costly borrowing. Avoiding unnecessary debt, particularly high-interest consumer debt, becomes a priority because interest payments represent money transferred directly to wealthy lenders who have no obligation to the borrower's financial future. Seeking employment that generates income above the rate of inflation preserves purchasing power and allows for capital accumulation. Finding ways to participate in asset ownership, whether through real estate investment, dividend stock purchasing, or small business creation, allows ordinary people to benefit from the same capital accumulation dynamics that make wealthy investors wealthy. For wealthy individuals like Robert, the current interest rate environment and economic structure provides multiple tailwinds. Maintaining liquidity to deploy during market downturns creates enormous opportunities to purchase quality assets at favorable prices. Diversifying across real estate that generates rising cash flow with inflation, dividend stocks providing steady income, and bonds generating attractive yields creates stability and ongoing income regardless of economic conditions. Avoiding excessive leverage means that higher interest rates do not squeeze profitability, but instead create competitive advantage over leveraged competitors. The wealthiest individuals maintain flexibility to adapt to changing conditions, neither overcommitting to any single asset class, nor so diversified that returns disappear into mediocrity. The uncomfortable reality is that high interest rates, while painful for most people, often represent conditions under which wealth inequality expands rather than contracts. The wealthy have capital to deploy when prices are depressed, income from existing assets that increases when rates rise, and the flexibility to adapt to changing economic circumstances. Ordinary people face higher borrowing costs that reduce their ability to access housing and education, depleted savings that were already thin, and vulnerability to economic shocks that force costly borrowing. Understanding these dynamics is the first step toward making financial decisions that protect yourself against these structural headwinds. Building toward capital ownership, maintaining financial flexibility, avoiding unnecessary debt, and taking a long-term perspective on wealth building are the strategies that allow ordinary people to eventually benefit from the same dynamics that perpetually reward those who already possess significant capital.